With him, he's the managing director at Exchange Capital Resources. Larry, good to have you back on the show. Let's talk some treasuries this morning. What are you looking for in today's action following the weaker inflation print?
Yeah, I think we're in a defining moment here for the Treasury market. And yeah, today's results from CPI were disappointing, but given the recent gains that we've seen, it's not changing the narrative in my mind. But I think we're at a defining moment because there's a split camp. There's those who believe that following the vaccine is job number one, the distribution of logistics, or the logistics of distribution and the end game. Like, when will we return to a new normal? Against people who think that keep looking at higher case counts, hospitals being overwhelmed. That latter just is going to continue to keep a little bit of a bullish underpinning to Treasuries. I don't hold on to that. I think we're in a new normal, but the next 2 weeks will be pivotal.
Now, Larry, we've seen bond market once again be very volatile, as Ben and I were just discussing. We've had this kind of channel to the upside since August, and then post-election, the bond yield dove to the low end of that. And the talk that I was seeing, people were saying, okay, here we go again. Here comes the big bond buying surge. Who knows where that move might have ended up, but then this vaccine news hits, flips it back around, sends it to the high end of the yield range. So are you on the side of potential breakout to the upside, or that we should still view this as being a market that's capped in terms of how high it could go?
Yeah, I still think the next week or so will be very key in uncovering that for us. But from my mind, I still believe that we're going to see higher rates by the end of the year. It's not going to be easy. It's not going to be one way, but I think we will. And I think a lot of that is because it's more about the logistics of at least being able to see a new normal down the pike, as opposed to being so concerned with case counts and hospitals being overwhelmed. I mean, those things are real. They're troubling, but I do believe a new normal is something that we can see, or the market can see. So all that to say, we have to remember that, tens began the year at 188. And so for us to get up to 1% by year end isn't that big of a deal. But I think what goes into the mix there is like, what happens to equities if we do get beyond that 1%? Mm-hmm. Are we going to see a deterioration of the equity market? And if so, if and when will the Fed get involved?
Do you think, Larry, that has been part of the reason why we're struggling around the same levels of September for equity markets? And NASDAQ rejected again from 12.5. S&P's failing to break through despite this vaccine news, sending a corner of the market on the reopening side way higher earlier in the week. Do you think that rates are playing a role in the way tech has been lagging in the market, the way these high valuation stocks have been dragging us to the side and downward?
Yeah, no, I think it's playing a role, albeit limited. I think really there's going to continue to be some bullish underpinnings with people believing rates will go down because of the unknowns that are still in front of us. But yes, we had the garbage rally on Monday. Momentum took its course with value, rearing its head. And yeah, for sure, that's definitely playing into it all. But I think overall, it's more about people just taking money off the table and realizing that, we're not in the clear yet. And so if we get rates up near 1%, we're going to see a stall. But, all that to say, I still believe we'll see higher rates by the end of the year.
Larry, in terms of the relationship between stimulus and bonds, we have to kind of go through the avenue of inflation. Do we know sort of what the impact on inflation of the previous 6 months of support from policymakers has done? What role has that played if we're not, zooming higher in inflation? Should we feel comfortable then that more of the same, if we get more stimulus, will also not cause inflation to surge? Or is this still something that's TBD in terms of the cause and effect?
Yeah, no, you brought up an excellent point, because I think one of the outliers or things that to be decided or to be determined is, are we going to see more monetary policy inserted into the market or fiscal? And so that's also playing are wreaking havoc with both the Treasury market and the U.S. dollar. I mean, if we see more monetary policy, of course, that's bearish for the dollar, not so much for the Treasury market. So I think that's what people are waiting on, and it's really a combination of the new administration combined with the trajectory of this pandemic and the success or alleged success of the vaccine. So just recently, we've seen a downtrend in auto, a downtrend in medical services. That should make some sense, but perhaps the exodus from the cities to the suburbs have run its course, and the pandemic has kind of leveled out a little bit, at least until recently. But that said, we've had some pretty good gains over the past 3 to 6 months with regards to inflation prospects. And for it to falter a little bit today doesn't concern me. I don't think it's a beginning of a trend.